Well, happy Financial Fitness Friday. Today we're talking about common investor biases. Bottom line on this is we all like to think that we're rational, logical beings that make well-informed and reasoned decisions always, but um, the reality is much different, that we are all susceptible to and most likely impacted by various biases that could have negative um, long-term financial impacts onto us, as well as other things. And hopefully by the end of this, you'll at least have an understanding of these biases, recognize that you're likely affected by many of them, and hopefully have some tools that you can help maybe mitigate them. And part of that is just self-awareness. But now we'll go on to the poll question. So in the first one, and these are going into some of the biases that we actually see. So in the first one, it's about this kind of positive. If we know that 100, 200 people will be saved, people tend to choose that rather than the riskier one, which these are really the same thing. The probabilities of these, they're really the same result, A and B. But people tend to pick A when giving it because our mind doesn't analyze probabilities correctly, and we look for things that are positive. And if it's positive, we go for that. If it's a given win. So in this case, 6 out of 10 in our group said A. So we're still in the majority, not quite as much as this. Number two, this one's always good. 73% of people are above average, say they're above average or better at drivers. And there's also at a poll like people at Harvard, men at Harvard, 85% of them think they're better than average looking. Obviously, more than 50% can't be better than average. And in our poll, 70% that they were better than average drivers. 7 out of 10. Let's see. This one's interesting. The next one, actually, you guys went a counter to. Normally, people pick Fund A. Because there's a positive thing where it shows that it's better on decline. People use this called recency bias, and they'll often choose A. In this case, though, actually 3 out of 10, only 3 out of 10 picked A. So the majority picked Fund B. Maybe that's because they're engineers as well. But okay, next question. In this case, the majority in this scenario is pick A. That goes back to that positivity thing. It's a sure thing, or you don't take additional risk if you've got definite money, where you could double it with a coin flip. So just like the majority do, 6 out of 9 pick A, take the $50. The next question, question 5, this is kind of the opposite of that earlier question. This one, people will die. So, and people usually will take more risk to avoid a loss. So more people, and just like we did, 7 out of 9 picked B. Even though it's the same thing, like same thing as the previous question, they're all the same probabilities. In reality, they're all the same answer. But because of that we will take more risk if there's a known loss. Whereas if we have a known positive thing, we won't take risk. We'll just take that positive. It's kind of interesting, and we're demonstrating that right here. And then the last one, the majority picked 2. In general, this is kind of the same thing. You'll take more risk. You might lose another $50, but you'll take more risk just to not lose anything instead of taking that known loss. And just like the rest of the studies have shown, in here we 6 out of 9 picked scenario B as well, where you take the additional risk. Any questions there? Pretty cool. All but one. One was an outlier, but the rest we were like everybody else. Here's what we're going to talk about today. Quickly, before we get into common investor biases, we have to, I think, have a little understanding about modern portfolio theory, and then that rolls into behavioral finance and all these biases. Anybody know who this is? I wouldn't expect you to. If Ian was on, I would expect him to, because he's from Rady. So this is Harry Markowitz. He's all should be thankful to him. Actually, he's creator of modern portfolio theory, and it is really kind of the scientific approach to portfolio management. And he actually won the Nobel Prize in economics in 1990, and he was a professor at Rady. That's why I expected Ian. He went to Rady Business School to know, but he kind of was a huge contributor to modern day, portfolio development, and then other people built on what he did. But brilliant man. And in general, his what he kind of showed is not the case. In general, we think as we take more risk, we expect more return, right? Like it's a linear thing. Well, what he showed is that's really not the case, and developed what's called the efficient frontier, which graphically represents portfolios that maximize returns for the whatever risk is assumed. And so it shows like here what's interesting, bonds which are tend to be safe. Granted, last year was terrible. We're in over 100 years in bond returns last year as we spiked the interest rates up. But actually adding stocks, which are more risky, decreases the risk and increases the return. So, um, and then as you go up, there's a certain amount above this line are returns you can't achieve. It's just not feasible. And the low here is where a lot of us lie. We take more risk for less return, which go to the next slide. It goes into a little more on the efficient frontier. So um, on the left, that kind of shows examples. H is impossible. There's no such thing as a portfolio, but anything along that line is the same risk-adjusted return. It's like the lowest risk for the best return given that level of risk. Does that make sense? Whereas take for example, C, E, and G. E, this might be, say, some individual stocks where C might be some kind of index as well. You're going to take the same amount of risk for definitely a lower return. Does it make any sense to do that? No. So what you want to do is get your portfolio as close as you can to the efficient frontier. And there's various, even if you go on to personal capital, they'll look at what you have if you put in your stuff, and you can see where you're at on the efficient frontier in terms of, diversifying out your risk to get the optimal return. And then this graph here, I'm not going to go into it, but this shows the dotted lines are these indifference curves where that's the combination of portfolios an investor will actually will take for the given amount of return. So there's like so much risk they'll take, and as you um, typically more people are where that crosses the efficient frontier is the best portfolio that you could have. So if you're higher risk, you could tolerate higher risk. This I0, you might end up with a higher return, but definitely more risk. More risk is involved as well. But ultimately, they're all the same along here. It's based on risk and return, expected return. Does that make sense to everybody? Okay. So here's what the assumptions that come out of traditional um, modern portfolio theory. Investors are rational. um, Markets are efficient. Mean variance portfolio theory governs. I'm not going to get too much into that, but I'll explain. And risks are determined by, or returns are determined by risk. So, you have some risk-free rate and then some beta, which is how volatile that is compared to the average market. And then your return is some linear thing based on that. That's not really the case, but the rational investor, this assumes we're all pretty much robotic. We prefer wealth as compared to less wealth, which sure everybody does, but we're not confused by the manner of that wealth. And we make very decisions very automatic that don't take any emotions into a case. If markets are efficient, that means that really that um, all the relevant information about the stock is available instantaneously, so you can't really beat the market. And as we've over time, markets have gotten a lot more efficient, but they're still. I mean, we have these. It's you still see these run-ups and rundowns that make no sense because if it was automatically efficient, you could never beat the market, even if you had insider information, because as soon as information's out, it's known to everybody, and you can't do better. But what behavioral, actually, I'll go into here's what they assume about investors. Um, I think some of these kind of make me laugh. Not biased. I mean, these are the assumptions they make. They had to do something, but and then behavioral finance, which is a much newer topic, it said, well, hey, wait a second. If investors are rational, why are there so many biases and so many errors? Um, it tries to answer these questions and develop, you know, take the same scientific framework of modern portfolio theory, but make it better for us emotional, non-logical humans. And they come up with these assumptions that investors are normal. And by normal, what does that mean? Normal investors have wants and desires and may commit cognitive errors, whereas the rational does not, um, through biases and otherwise. They may be misled by emotions while they're trying to achieve their wants. Markets are not efficient. Well, it's very this is the interesting thing. It's difficult to beat markets, but the concept is that deviations in price from the fundamental value, which is what, markets being efficient, it would always be at the stock would be priced correctly for its value. Whereas this, we see stocks run up and run down in reality, and there is an opportunity to buy at a discount or sell at a premium. But the challenge is, in reality, timing the market is impossible, and most of us are not smart enough to figure that out. So it's still better to just go with indexes, but risk doesn't alone determine uh, returns, and then the portfolio, um, behavioral portfolio governs, which is pretty interesting. In modern portfolio theory, it just assumes that we assume everything as a whole, and we make the choices that provides the best returns. This automaton thinking. In reality, they go into kind of like the hierarchy of needs. We bucket basically different categories and take more risk for those things higher up. So money to survive, money to safety, much less risk. So that's where we keep things in cash and savings account. But as we go higher up, we take more risk for that dream money, the house in, the island getaway, etc., the yacht. But does this make sense to everyone? Okay. Okay, and here this goes into what we're covering on the cognitive biases. Just going over in general heuristics, and then random guess monger. Yeah, sorry, Mike just saw your chat. But we'll cover all of these and see if you feel like you're impacted by them. So heuristics, shortcuts to simplify the assessment of probabilities and decision-making process. We do this all the time as humans. Um, the then it usually breaks down into, typically they talk about three of them. One, the affect is you judge something quickly without consciousness. We do this all the time. We partly need to because we lack of capacity. But I'll just give you a chance to take a look at those. The availability heuristic. Hey, what's been recent memory? You don't look at any other information and you make a decision. And then similarity, something similar. So it's really not similar, but you don't take that into account and you just make the decision based on what you known from a previous similar situation. And then I found this picture about heuristics versus rational thinking. And question though, what do you guys think? Intuitive versus deliberate decision making, which is better for complex problems? Do you go with the quick unconscious thinking, or do you get deliberate? What's better?
Well, this is Lynn. I kind of do both. I have my initial response, but then I tend to go to the rational thinking and go in and dig deeper to see if my guess was kind of correct.
Kind of correct. Yep. What they've actually found in studies is that because of our conscious thought, we have limited capacity. That's best suited, our deliberate thinking, best suited for simple decisions. Whereas unconscious thought is actually a lot of times is better for complex choices. So what I saw, I thought on this, I'm like, okay, actually error prone, the more complex it is, the more our rational thinking is prone to be wrong, to have errors. Or we think what we're just choosing is rational is really not. And they did this based on examples of simple being, hey, having 4 variables and complex having 12 variables. And consistently for the simple, those 4 variable choices, deliberate rational thinking worked best. But as too many variables came into play, actually just the unconscious intuitiveness was better, because you don't know when there's too many variables, your rational mind doesn't know what to weigh, what's important or not, and it's just start kind of pushing things off. It's, what do they say? It's pretty interesting, but they as complexity increases, deliberate thinking begins to fold in on itself, and it becomes difficult to know how the various assets of a decision ought to be weighted. I remember, um, they, like in this example, when they're looking at a whole bunch of things on a car. Okay, when you're trying to rationally think about, hey, wait, is good horsepower more important than aesthetic appeal versus um, fuel efficiency? All of a sudden, you try to start weighing all these things, and you don't know what's like more important, and you end up making decisions that aren't typically as good. The same is true often in home buying. Like when people think about or asked about where they'd rather, what kind of home would they want? A small home, close to, downtown, or, close to work, or they can get the large place, further out where it's going to be a longer commute. And what people chose when they rationally thought about it was the large house, because they have the extra room, and then the family can come over and they have the spare bedroom for a space. And so 98% of the time, their life sucked much worse because they commuted hours, way too many hours, and so their daily life was terrible because they chose that large house further out, whereas the location was much more important to a daily good life. It's kind of interesting, but any thoughts there? But a couple of good books. I post them later too. But predictably irrational and the behavioral investor are good books just about this topic. Okay, on to anchoring, also called conservatism or belief perseverance. And this is something that's really hard to avoid. And sales, they can use this tactic very well, where they use a large number initially, large dollar value, and then when they cut it in half or something else, now you're already anchored that larger price in, um, and so you can't help but set this kind of anchor that may say even something on sale, it might be a lot higher than you would have initially considered buying, but because you anchored this number, now all of a sudden it seems reasonable. How much should a time engagement ring cost? Anybody know? Like, think of that marketing. What do you guys? What's the normal?
Isn't
What's
it like
that?
something like 10 times a 1 month salary or some ridiculous thing? Or
Actually, well, not 10. Thankfully, but it was De Beers, the cartel of the
yeah,
industry. Like, how how else can 2 months salary last forever? Um, so everybody has this 2 month salary is how much it could cost you for a diamond, an engagement ring. One, it has to be a diamond, and that's your engagement ring. But that's a classic example of anchoring that it impacts most of the U.S. And then investing, though, often how this, and it'll go into something else called the disposition effect. But something say you bought a stock, that price you bought it at is your anchor. So a lot of times, if it goes below that, you won't sell it, even though the price maybe the right choice would be, because you're anchored on that, and so you're going to try to wait for it to come back to that price, even though it doesn't ever, and you just keep losing. So, any questions on anchoring? Does everybody know? I mean, admit that these this bias impacts them. Yeah, same here. Okay, next one's confirmation bias. This is probably the worst one and probably the most um, prevalent, I would say. The tendency to overvalue data that supports your pre-existing belief. I like the little Venn diagram there that, you only look at the evidence that supports what you believe in making a decision. Think about, it comes at so much in politics. How many right wingers would listen to something, say, talk radio on the left? They don't. They listen to Rush Limbaugh or whatever, and vice versa. Both people only look for um, for things that support what they already believe. And this is kind of interesting. Like, we all think we're right, or we want to show that we're right. And maybe this is for self-preservation. Because imagine if thinking every decision you made was wrong. You know, that can be very depressing. So this might be more for survival, avoid depression. But the challenge is with investing, this can really hurt us because you only look at information. Hey, you think Tesla's a good stock, so you only look at things about how good Tesla is instead of all the other negative things that that you could look up, but you only find things that support what you already want to do. The other thing they gave a good example is financial planners are cheats. So, and a lot of them are, I think, but not all of them are. And there's a lot of fiduciaries out there. But because you have that, when you look up information, all you do is search under a Google of, the negative side of financial planners and how they're robbing people. So I just put, have you guys ever seen, you guys get the reference to the George Costanza approach? It's the opposite, I titled the opposite. It's like 22nd. It's the final episode of the 5th season. I love Seinfeld, but it's when George decides that every decision he's ever made in his life is wrong. So he'll do the exact opposite every time, and it's hilarious because I also think of that as the Even Steven episode because Elaine and him, like they start out, Elaine's all life is all good. George's is terrible. Then he makes this decision to do the opposite of every decision, and all of a sudden he's going out with a good-looking woman. Like everything is going well because he's doing the opposite of what comes to him naturally, and Elaine falls off. It's just a hilarious episode. So, next one is recency bias, and this is we give too much weight to recent observations versus long-term trends, or we just totally blow off longer history. And this is sad. And I think of this also just when you're looking at, especially when you're investing and early on, Morningstar mutual fund ratings are probably like one of the worst things you can look at. But I think of that also in terms of recency bias. They might have some new fund that's just doing really well, and so it's ranked 5 stars. And yet it returns to the mean once you get your money in there, like all of them. It's these active managers fail to beat the market long term, and so you buy into this, and what seemed like a 5-star rating, you're suddenly having poor performance where you could have just bought the index and done much better. But any questions or thoughts on this? This one's also that heuristics we were talking about. It's closely related to that availability heuristic. What's in recently in your memory is how you act. Then there's the gambler's fallacy, also called the Monte Carlo fallacy, which is this is one that math geeks, even though they understand probability, are still susceptible to it. Like the classic is say they're doing 100 coin flips and it hits like heads, like and it's a good coin, it's not weighted wrong, but it's like hits 10 heads in a row. What do you think the next one's going to be? And people just naturally want to say it's going to be tails. It's been heads too many times, but it doesn't matter. The probability doesn't change on that single coin flip. You know what I mean? It's still 50-50 heads or tails. So there's no more likelihood. But because of that, we this gambler's fallacy, we tend to think, the probability changes for some reason. And so this can hurt us in a number of ways that, as far as investing, that we might sell something that's going up because we don't think it can keep going up. And yet it does. And then we just lost out on potential gains. I thought of this as recently, people selling their homes because prices have been going up really high because they don't think it's going to be high. And this happened to a friend of mine in 2018. They're like, oh, these, it's too high. It's prices can't keep going up. Now they're renting and prices shot way up since 2018, and they're kind of priced out of the market right now. So this is one that's it's important, and nobody wants to think they've got a gambler's fallacy, but it affects too much of us. Hurting. This one it impacts a lot of people as well. How many people like bought crypto or something just because of whatever everybody else is doing? .com, like the .com, I think they went up 400% over a couple of years. I mean, crazy, and because everybody just kept jumping on them, following the herd, even though eventually, as you see in the picture, leads to running over the cliff. Also, the housing bubble in 2008. They actually said that housing prices had to go up, will always go up. I mean, how ridiculous is that? But that's what they put out to the public, and people believed it and kept buying until we had the Great Recession, which, who knows? I think many people believe it was just called a recession for politics because they didn't want to say we were in another depression. But so how do you avoid some of these? Like some of it is the important things are establishing an investor policy statement that you refer back to, and you do that in times of calm, not when you're freaking out and emotional. But I also think of like passive investing, setting up your a set portfolio, and then ultimately people a lot of times talking with a financial advisor is helpful, someone that's good. But understand that all these money managers, if they're managing your money, which I'm not typically a big fan of, but they're susceptible to all these same biases as they're set, picking stocks and other things as well. Okay,
It
hindsight bias.
kind of goes to Warren Buffett's advice: if everybody's doing it, do the opposite or
Yeah,
something.
well, I don't remember
exactly what it is, but
him and Munger both are about contrarian thinking, and that goes into like especially like also confirmation bias. Hey, thinking of the opposite, like don't make sure you're not just following the herd or that you're questioning, being your own devil's advocate. Hindsight, this is one. Yeah.
When the financial advisor tries to entice you only because you belong to this group, you have these private funds available. You have to take with risk, but it's going to be pay off because you are taking the risk. So it's always the same sale to tell you that you are special and you can get more because
Right.
you belong to this group. So they are not really looking after you, even though it said that they are supposed to look after you and invest as per, but I don't believe that anybody does that. Again, I'm going like very general way, putting everybody in the basket, but that has been my experience.
Well, and Shalom, I think you're right. I wouldn't say everybody, but okay, so take assets under management where people take a percentage, which is what most people do, and they're considered fiduciaries, but they take, say, a percent of your portfolio value as their fee each year. If Fisher Investments is one of these, and they're classically like, we only do better when you do better. I don't like their slogan, but there is a conflict of interest. And so what do they do to defeat that conflict of interest? Assets under management, in my opinion, they should have a capped amount that they charge you. Like if you let's say $500,000 you have, above that, they take a percentage of that, but anything above that, they don't take a percentage of. Does that make sense? So then there's that helps mitigate any conflict of interest, such as, like, hey, I don't want to do Roth conversions because they're going to charge you for all the money that you haven't paid taxes on. That's where Edelman financial advisors, they're not into Roth conversions, but they want you to keep your mortgage as long as possible. Why is that? Because paying down your mortgage is going to lower your money that they can charge you assets under management for, right? I'm not saying this is exactly how they do it, but why else do they want you to keep a mortgage but not do Roth conversions? It's so that you have more liquid money that they can charge you a percentage on. And then, Chalma, the other thing, like you're thinking of, I think so many of the others who are not fiduciaries at all, they're selling you products. So they're making commissions, and that's how they make their money. That's where you look at in insurance. First Command is known. They got a big suit against a military for cheating out the military personnel. But yeah, absolutely. But there are a lot of fee-only financial advisors that are fiduciary and are looking out. But you have to have the right questions to ask, and it really comes down to whether you can trust them or not. So, but big chicken dinner, that's not how you you choose a financial advisor. or the steak dinner that they do at so many, like 55 and older places. Very frustrating. But this hindsight is a tough one too, because this makes us think we're geniuses in the future. Um, Looking back on, oh yeah, I must have known that, but this really leads to overconfidence and maybe a myopic view. And it happens to all of us. Like I remember in 2017 saying, "Man, this market's way too high," and it is too high. Things were overvalued, but it kept going, kept going up. You just don't know. It's random, but you could really hurt yourself by thinking, based on, hindsight, that when the next crash is going to happen, then you take out your money, go to cash, and then you're stuck and you don't know. And the market keeps going up and you keep waiting because you don't know when to put your money back in. And you end up losing all these returns. So it's something to be mindful of and self-aware, so that you don't think you can guess, because timing the market takes timing it twice, which doesn't work typically. But how many of us have thought that at some point, like, oh, the market crash is definitely coming, et cetera, and then it doesn't, and then out of the blue it does, but you weren't expecting it. Okay, so who's the better investor here? Well, men tend to trade much more than women, and single men outtrade single women by large numbers. Here's what happens in general: underperformance per year of 1.4%. Single man underperformance by 2.3% per year. And then they did this studies across 19 major stock exchanges. So this is a global phenomena as well. Thinkers trailed buy and holder investors by 1.5%. What do you think? Is that a big deal? Well, let's look into the numbers. Sadly, this is something that we're like have this tendency towards action, but a lot of times that's actually damaging to us in terms of investment. So here's a quick example showing what those returns, that it makes more. You see the numbers. Made an assumption. This is we're investing $1,000 a month for 35 years, so that's $12,000 a year. For and assuming you get an 8% rate of return overall, and that's what she's getting, just buy and hold, not tinkering. She ends up with 2.294 million. Now the average man, 1.4% lower. Here's what he gets: 1.56, a loss of $730,000, and that's 32% of the gains. So that 1.4% compounded over those years ends up being nearly a third of the money they lose by being overconfident. And then a single man, even worse. Look at that, nearly $1 million lost, and almost 42% of the gains lost. Crazy, huh? You're not as smart as you think you are, guys. So it leads into overconfidence. They listen mostly to themselves, and they think, I've seen this too often. I saw this in the military. This is one of the things that got me into wanting to educate people. Because I see especially senior enlisted that have been in the military for a long time and hadn't been investing or doing anything, sadly, for too long. And then all of a sudden they read a book on investing and they think they're smarter than Warren Buffett and everybody else, and they're going to go beat the market. And it results in frequent trading, as you can see, you saw by the previous slide. It doesn't do it typically only hurts. Day traders, 99% of them lose money. But you hear about those? No, you only hear about the people that brag about when they did well. Okay, next one's overreaction, and this was probably this is the difference between the rational investor. The biggest thing about the difference between the rational investor and the normal investor: we do overreact. This is what freaks us out when a crash happens, where people they need to do something and they go to cash, and they're stuck in cash, and then the market recovers and they miss out on the huge gains. But this is where I think of, like, for overreaction, this is why you need to put things on automatic and always be buying while you're accumulating, so that you don't let your emotions your natural tendency towards overreaction put you in a bad situation long term that you could never recover from financially. And the news, of course, doesn't help us. You guys know Kramer, right? The guy that's on MSNBC, super loud. Like they've done analysis that if you took all of his recommendations over time, you would have lost money. not only would you have not kept with the market, you have lost money. The news are only there for clicks and for their own money. So they want to scare you, they want to freak you out because that keeps people coming back, but it's damaging for your money. Okay, prospect theory. Now this is where we went into those questions about would you take the $50 now or take a coin flip? So we look at gains and losses differently, and we place more weight on perceived gains than losses. And it's really like losses have an emotional pain of twice what the good feeling is of a gain. Actually, much of the gain is dopamine. It's the anticipation of a gain, not actually getting that gain, which is kind of interesting. But you see on the graph there, that shows like how much happiness you get out of a gain versus doubly, it's so much more pain that you get from a loss, in the example of $50. And that goes into those questions where we were just like the rest of the people. You naturally took the $50 instead of doing the coin flip or to potentially gain another 50 or lose it. Whereas when you had lost $50, you took more risk to potentially not have that loss, even though you could have doubled your loss. Very interesting, isn't it? But that's how our mind, that's how we think, how our emotions impact us. Disposition effect is similar to prospect theory, and prospect theory, this is also with anchoring. So we are much more likely to sell a gain than something that's lost and is not going to we don't want to realize that loss. We just let it go. And what they found is on these studies that when they looked at those stocks that people sold that for a gain versus what they could have sold for a loss, those winners outperformed those losers, which were held, by 3.4% the next year. I mean, think about that. That's compounded over years, just as we showed with the overconfident male versus the female. It could be significant differences long term, but we like gains, and we don't want to realize a loss, even though the right time to sell is just the right time to sell. Sometimes you just need to get out if it's a bad thing. Here's the example of take our stock. I remember talking with somebody, they wanted to sell a portion of the stock they had, like from ESPP and RSUs, and they wanted to sell a batch that was a winner. All the stock they have, it doesn't matter. It's all the same price, right? You know what I mean? So you had some that's a loser, some that's over the years, some some is likely a loser, some is likely a winner. But if it's all the same, then sell the loser. Then you can use that to offset other gains. But it's just interesting. That's how we naturally think. And it took a while to explain like why no, you want to sell the loser. It doesn't mean you're a loser, but it's the best thing for you financially. So, and then here it comes down to like these are things to talk about. How do you mitigate? How do you manage these biases? Because we have them. I mean, I think we all admit, right? This is part of us. But so how do we do it? I think part of it's self-awareness and knowing that these biases are there. That's why we're doing this. It's that you realize, and when you're making decisions, you can remember, hey, what biases am I getting impacted by? And you could maybe be the devil's advocate, to make sure you're not making a poor decision, emotionally based, or one of these other typical things. And as you said, Shama, you don't know. I'll get there's a number of questions to ask a financial advisor as well. If you're interested, because you're right. I've as Chanthan knows, I think on the first discussion I said, I was kind of negative towards financial advisors, and I do think the majority are still not looking out for your best interest, but there are plenty out there. And there are certain, like Garrett Planning Network, there are certain ways where you can go find ones that are fiduciary, and they're held to a standard, and they pay to be part of these groups where if they're not meeting the standard, it'll be known and they'll be kicked out. So But I think much of it comes down to, one, they've got to have technical competence, which all of them should, but they don't, especially insurance companies. Oh my gosh, I'm stunned how people try to sell you things, yet they have no idea the rest of the investment atmosphere. Like they'll try to sell you on some whole life policy when you're young and have no family, yet they don't know what a Roth IRA is, or the matching, talk about matching the 401k or any of these other investment vehicles. And it's to me, it's criminal actually. But and then the last thing I just pointed out, like meditation. I don't know how many you do meditate. That's something they mentioned is that actually does consistent meditation really helps with mitigating these biases. And I think that makes sense because what meditation really does is give you pause, before you make and one of these kind of irrational or quick decisions, you might have a little space to think, to let your rational side actually think, and prevent a poor decision. And then here's some books mentioned. These are Predictably Irrational. It's amazing. It's like actually disturbing when you read it. But Psychology of Money is one of my favorite books on money. And the Behavioral Investor is good. He's also he's got like some kids books that his titles are pretty funny. Like You're Not That Smart and some other things. But he's real sharp as well. So okay, so well, what do you guys think? You guys notice any of these biases in you? Um, any more self-aware you think about these as life goes on?
How
Uh,
about fear to commit? You
that's
hear
true too, and
everything, but it's very hard to commit.
that's Daniel Crosby talked about that in. I couldn't go into all these things, but that's kind of conservatism, and so you don't do anything, and so you don't commit because it's easier for us to not make a decision than to make a decision and it be wrong. So we don't make a decision, even though a lot of times in investing, not doing anything is a lot of times the best thing after you've set up your portfolio and you've got things invested, but no, absolutely. And that's conservatism. And that's a, John, we'll talk about that. I'll look at some things things that they talk about of how to overcome that, that conservatism. But, and then here's other topics
How
that,
about
yep.
adding the financial advisor? And how about adding, when you get closer to the retirement, how the philosophy should change? Should you put more money into 401k, or should you do the rollover? Like these kind of topics, like depending upon where you are,
Yeah.
your life cycle.
No, absolutely. And that's where personal finance is personal. And that's why that's why I can't say any of these are specific recommendations or advice, because everybody's situation is different. And as you're closer to retirement and what you want in retirement, it depends on how you would want to set up your portfolio. But you wouldn't want to be all, while I want people to be all stock when they're really young and, and get as much returns over the years as they can. As you get closer to retirement, you don't want to be that aggressive. You can't handle that serious drawdown that could take years to recover. So you balance it out. And then there's even some that have, like you're talking about rollovers and stuff like that. I highlighted the next thing, Secure 2.0 changes. Congress did just sign something into law which totally impacts upcoming retirees. That whole thing about the Roth 401k, how we have to do RMDs. Well, in 2024, we won't have to take RMDs from there. So maybe we don't want to roll it into an IRA. We may or may not, but it's changing the land. These decisions are changing the landscape of what we want to do best, for us. Because like a 401k has better ERISA protections than an IRA. If the investment choices are good, maybe you want to stay there. Anyway, but I thought maybe we could quickly go into the Secure 2.0 changes. That should be a pretty short topic, but it's important for people. because it changes RMDs and all sorts of things. But there's like 10 things that kind of, even though it's like 1,000 pages, but probably 10 things that are worth talking about. But here's other topics, and I'll put out a poll for any other questions you guys have or thoughts.
I'm interested in credit card travel hacking.
you that's what you want. Yeah, that's it. That's a good topic. Anybody else with
I
it?
enjoyed the discussion a lot. Like I knew about a lot of these biases. I just was never as honest to myself about having them. So I think hearing you talk about it and being very specific about examples and everything, has really ingrained that a bit more into me.
Good, and that's why we did this. It is exactly because it's easy to be in denial about these things, but
Yeah.
when they're presented to you, and I mean, I'll admit, I every single one of those, it is something I'm subject to, and I have to, work to, battle against, I guess. I mean, it's we're human. That's, some of us. That's why actually, Mike, you know what? Like some of the best technically investors are like Asperger's syndrome. These people that have no emotions, they're the best investors because they can be that rational, automatons. Whereas we, in general, the average human, we can't help it. I mean, our brains are not, we we can't help but still have, what's kept us surviving, and that, that lizard brain, which is so good for us living, is terrible for us in general investing. It's kind of the opposite. But once we see these and we can recognize them, that self-awareness will hopefully help us mitigate and prevent it from causing us to make poor decisions in the future.
Can you add 210 concept to the tax planning to your selection list? Like generally you ask what you'd like to have it next. So maybe you can have 3 or 4 topics and see what people are interested in.
Okay. Yep. What do you want specifically about tax planning? And we are going to do, we can do one just specifically on tax planning, but I've done like we're going to repeat in not next one, but the second repeat topic, probably in March, will be on that Roth versus traditional and lifetime tax management, which goes into, important, significant long-term thoughts about how to minimize your taxes overall throughout life. And any of it, if other questions, or recommended things, I'll add them to the list here. Throw them in the Slack channel, and happy to add those in. So, okay.
Thank you, Alan. I
Yep,
really
you're
look
welcome.
forward to your webinars.
Oh, I
Thank you.
just saw some of the deliberate. Most people said deliberate, by the way, on complex decision making, and I just saw in the chat that, but we realized that that's actually not often the case. Excellent. Well, thanks everyone. Have a great